Imagine if $100,000 just disappeared overnight. Or worse, what if you thought you were investing, but your money was quietly leaking away? Today, we're ranking the most common assets people invest in from F tier all the way to S tier, the assets that can actually transform your life. And yes, just like our business model tier list, this is purely educational. We're looking at the data, the returns, and the risks, so you can make smarter decisions with your money. We're about to explore what would statistically happen if you put $100,000 into each tier. Some will shrink, some will crawl, and a few could build life-changing wealth. If you've ever wondered where to actually put your money so it grows instead of drains, this video is for you. F tier, the wealth traps. Let's start at the bottom. F tier assets are the financial traps, not really investments, but illusions of wealth. They look exciting, even glamorous, but they quietly destroy your money over time. Take the lottery. Americans spend over $100 billion a year chasing jackpots. The average adult throws away more than $1,000 annually, hoping to strike it rich. Statistically, your chances of winning are 1 in 300 million, meaning you're far more likely to be struck by lightning than to build wealth here. Luxury consumer goods, think designer watches, brand new sports cars, the latest phone bought on credit. These items look like wealth, but they depreciate fast. A new car can lose 50% of its value in 5 years. Warren Buffett has repeatedly warned that cars are one of the worst investments you can make if you're chasing returns. Even collectibles fall into F tier if you lack expertise. Remember Beanie Babies? Or NFTs in 2021, fads trick beginners into thinking they've found a shortcut to fortune. But unless you understand the market at a professional level, most collectibles end up worthless. And even legitimate collectibles like rare cars or art are liquidity traps. Your money is stuck until someone wants to buy. What ties all F-tier assets together is emotion over logic. These are consumption, not investments. They drain wealth while making you feel like you're playing the money game. Put $100,000 here and watch it vanish, depreciate, or sit frozen for years. D-tier, weak but functional assets. One level up, we have D-tier assets. These can work, but the odds are stacked against you. They're too volatile, too illiquid, or too luck-dependent to reliably build wealth. Commodities like gold and silver are classic examples. Yes, they're marketed as safe havens, and during crises like 2008, gold spiked 25% in a single year. But over the long term, gold has returned only 78% annually, barely outpacing inflation. Commodities don't generate cash flow, they just sit there. Single rental properties also land in D tier, especially for small landlords. On paper, buy a house, rent it out, let tenants pay the mortgage sounds simple. In reality, vacancies, taxes, maintenance, and interest rate hikes can turn your positive cash flow into a drain. Mom and pop landlords often face the highest default rates, according to Census Bureau data. The key to D-tier assets is fragility. They might work in perfect conditions, but one misstep and your wealth stagnates or bleeds slowly. Put $100,000 here and it won't disappear overnight, but it won't skyrocket either. C-tier, steady middle-of-the-road assets. C-tier assets are reliable but unspectacular. They protect your wealth, often keep up with inflation, but rarely accelerate you toward financial independence on their own. Bonds are a prime example. U.S. Treasury bonds are safe, stable, predictable. Over the past 30 years, they've returned 4-5% annually, compared to more than 10% for the S&P 500. Bonds protect wealth, they don't multiply it. They're like parking your money in a garage, safe but going nowhere. REITs, real estate investment trusts, are another C-tier option. They give exposure to property markets without managing tenants. Dividends can be attractive, but they're interest rate sensitive. In 2022, the FTSE Nareit All Equity Index lost over 25%. Over the long run, REITs underperform stocks while carrying higher volatility. Even collectibles with expertise, like art or vintage cars, fall in C-tier. They're real markets where fortunes can be made, but liquidity is a killer. Selling a Picasso or a rare watch can take months or years. Without a network, these assets often end up as status symbols rather than cash-generating investments. C-tier assets are solid but unremarkable. They diversify your portfolio and smooth risk, but they won't be the heavy lifters that build life-changing wealth. B-tier, reliable wealth builders. Now, we're entering serious territory. B-tier assets are reliable, proven, and accessible. They're where wealth building becomes repeatable. Millions of people have used these to climb toward financial independence. Index funds are the cornerstone. The S&P 500 index has returned 10% annually since inception. $10,000 invested in 1980, today it would be over $900,000 without lifting a finger. Legendary investor Jack Bogle built Vanguard on this principle. Stop stock picking, ride the market, and let compounding work its magic. Dividend-paying stocks are another B-tier favorite. Companies like Coca-Cola or Johnson & Johnson have raised payouts for decades. Dividend aristocrats, firms that increase dividends for 25-plus years, historically outperform the market with lower volatility. You literally get paid for holding them, though growth is slower than reinvestment-heavy companies like Amazon. Real estate at scale rounds out the B tier. One rental can be fragile, but 5-10 properties? You diversify vacancy risk, create steady cash flow, and watch equity appreciate over decades. The U.S. Census shows multi-property landlords are the ones who see real stability and long-term gains. B-tier assets are repeatable systems. They don't rely on luck or perfect timing. Put $100,000 here, and over decades, it can compound into millions in index funds, generate steady income and dividends, or produce cash flow through a multi-property portfolio. A tier, powerful, demanding assets. A-tier assets are game changers, but they demand capital, skill, or patience. This is where wealth acceleration starts to get serious. Private equity and venture capital dominate here. Historically, private equity funds return 12 to 15% annually, outperforming public markets even after fees. The catch? Entry barriers. Many funds require $250,000+ and lockups of 7-10 years. Access and network matter as much as money. Franchises are another A-tier option. Proven brands like McDonald's or Chick-fil-A can generate $80,000 to $100,000 annual profit, but startup costs are steep, $500,000 to $1 million+, and approval isn't guaranteed. Commercial real estate rounds out A-tier. Multifamily apartments, office buildings, or shopping centers scale income in ways single-family rentals can't. CBRE reports 9% annual returns over 25 years, but entry requires serious capital, often $1 or $5 million with significant equity up front. A-tier assets are scalable systems with proven returns, but $100,000 may only get you a minority stake or a down payment. Capital is a gatekeeper here. S-tier, the true wealth machines. Finally, the crown jewels, S-tier assets. These combine growth, leverage, and scalability in ways lower-tier assets cannot. At the top sits owning your own business. According to the U.S. Census, over 70% of millionaires are entrepreneurs. A profitable business pays twice: steady cash flow and later, a sale at a multiple of earnings. A small sauce company making $500,000 annually might sell for $2 to $5 million, returns no stock or bond can match. Next, equity and high-growth companies. Startup founders, early employees, or angel investors can see life-changing returns. A $10,000 investment in Amazon's 1997 IPO, worth $1.6 million today. Rare hits, yes, but when they land, they create generational wealth. And in the modern era, scalable digital assets belong here too. The creator economy is a $100 billion+ industry, with top creators earning millions annually. Why S-tier? Leverage, technology, money, and people work for you, multiplying impact beyond individual effort. S-tier assets show the power of leverage and compounding on steroids. But for most people, building wealth doesn't require exotic strategies. It's about consistency, patience, and avoiding traps. Your path to wealth. Here's the takeaway. F-tier drains you, D-tier stagnates, C-tier protects, B-tier builds reliably, A-tier accelerates, and S-tier transforms lives. The choice is yours. Play it safe and slow, or aim for scalable systems that compound your effort and capital exponentially. Start by avoiding the traps at the bottom. Focus on repeatable, compounding assets. Increase your skill, your capital, your network. And remember, wealth isn't just money, it's freedom, security, and opportunity for your family. If you found this video valuable, like, comment, and share to help others avoid mistakes and build wealth. Subscribe for more high-value financial content and start turning your money into your most powerful ally today. Thanks for watching, and I would see you in the next one.